Let's start off with the shilling. As Mashuru says, still stronger. It's now around 84 shillings 80 on a much better looking interest rate regime. And of course, as she says, all eyes on the central bank and its MPC. What are your expectations?
Yes, it's true. It's actually quite impressive. The shilling at 84, it's performing wonderfully. And I actually think most of the end month demand has come and gone, because tomorrow being the end of January and the shilling at these levels, we don't expect it to weaken much tomorrow. So yes, quite impressive. As to the MPC, we still expect them to actually hold the rates where they are, because I mean, everything seems to be falling into place. A strong shilling. And also, if you look at interest rates, which are quite attractive at the moment, but what we're also seeing is that there seems to be some pressure coming on interest rates, downward pressure, as we've seen with the prime rates that have dropped, not by much, but by about 30 and 50 basis points over the last 2 to 3 weeks.
Okay, so currency recovering, inflation figures looking a little better, and expectations of inflation really being controlled in the year ahead. That should have a very positive bearing on the fixed income side of the markets, where the rates had started to increase, the yields were declining, and the sector just wasn't looking particularly attractive. What sort of thing is really going to give it a lift, fixed income in Kenya?
No, it's the fixed income, especially the secondary market, is already feeling the effects of much more favorable environment. What we're seeing, especially on the secondary market, is there's immense demand for short papers, 1 2 year, I'd say up to about 5 years. There's a lot of demand in the secondary market, no supply. Most investors are holding out, expecting rates to come off further. And as if CBK this month issues 2 year, 1 year, or 3 year paper, we should expect a lot more activity on the secondary market.
What does keeping interest rates steady mean for business in general, but particularly the banks that have a lot of their income coming from interest-related income, coming from loans and advances? Do we not need to see a little bit more movement by way of reducing, if I may use that term, interest rates going forward, just to stimulate credit to the real sector?
Banks have actually, I think they felt a lot of the brunt of the rise in interest rates we saw in the second half of 2011, especially towards the end of the fourth quarter of 2011. The effect of banks was quite considerable. We saw their cost of funds shoot up, and also base lending rates went up across the curve for all banks. This also has put their NPLs under pressure. We should see all these effects as they release their end-of-year results. And going forward, I don't think we're going to see rates coming off by much, in terms that will actually will affect banks' base lending rates. Rates will come off, yes, especially at the short end, but looking at 2012, we don't expect rates to come off, especially for commercial lending rates. We expect them to hold where they are. To keep a cap on inflation, of course, they've had to control credit growth, and I don't think the MPC is going to allow this to go the opposite direction at the moment.
I mean, obviously, we don't know whether elections will take place December or early 2013, but nonetheless, this is an election year. We do expect to see the government pump up its spending against all wisdom and all prudence, but the point is inflation should rise. So these notions that inflation will come down significantly, how realistic are they?
Of course, for this first quarter, especially like January numbers, we expect inflation to be around levels of about 18%. But I think inflation will really come under pressure in the second half, especially as you mentioned, government expenditure is bound to increase in the financial year 2012-2013. As we stand now, I think at the close of last week, government redemptions for treasury bonds were about 132 billion. The government will have to find a way to finance these redemptions. And I mean, the most obvious way would be to keep rates where they are, to encourage people to invest back and roll over their money. I would call rollover risk, to avoid the rollover risk. So I think inflation will come under pressure in the second half, especially as we begin to feel effects of food. The dry season is here. We're feeling it in January, February, March, and we expect it to hold till around July. So food index should come under pressure, and so should energy.
In these markets, finally, Kenneth, will government be able to raise financing through borrowing? Will they crowd out the market as they try to boost their expenditure?
I think that is quite a threat of them crowding out the market, and we've seen that actually happening. What's happening now is, especially, for example, the effect is quite pronounced on the real estate industry, where a lot of projects have been held off. I mean, most people have taken a wait and see approach. Excuse me. So yes, that is a threat, especially with such huge redemptions in the next financial year. The government may have to look at other sources of borrowing, especially looking at international markets. And as the political risk comes off in the coming year after elections, they may go into international markets as they've been planning to do for the last 2 to 3 years.